and welcome. You're tuned into Markets at Noon on ET Now. Well, a lot of headlines coming in as far as the macroeconomic condition is concerned. Remember, the WPI has hit the highest level in 3 decades on account of costly oil. We have rupee, which has hit a record low, and a lot of important indicators coming in from the economic front as well. So we are now joined by Aditi Nayar, Chief Economist at ICRA. They have just released a report talking about the macroeconomic indicators and how the activity has panned out in the month of April. Aditi, hi. Thank you so much for making time. Well, the April data is quite robust at 115 levels. But is it safe to say that we are trending higher than the pre-COVID levels? What's your assessment of the economic situation?
The ICRA business activity monitor stood at a very healthy level of 115.7 in April 2022. This is the second highest level in the last 13 months. So this is a very important factor. Normally, we do see activity dipping in April compared to March in every fiscal year. So this time the dip has been very small, and therefore we're at a second highest level in 13 months in April 2022. Also, of course, the YOY growth is very high because we're on the low base of the second wave in April 2021. However, when we compare to the pre-COVID level, we've got almost a 16% growth in the activity levels in April 2022. And this is quite meaningful, especially when we look at the breadth of sectors which are actually growing over pre-COVID levels versus a narrower set which are actually showing a contraction in activity compared to April 2019.
Right. Aditi, just stay on with us. Just wanted to highlight Vedanta is on an upper circuit. Hindalco is up 10%, 426. Coal India, ONGC, Tata Steel, JSW Steel, and I can just go on. NMDC is higher. And, clearly there seems to be an all-out either sort of short covering or delivery-based buying. But however, data for the metal stocks is something which will be very, very interesting in second half today. Aditi, just when we talk about the sudden change that all of these central bankers have done, focus has become on inflation, focus has become on how, to tackle this inflation. This is something which was known earlier. You think that most of the central bankers across the world have just started to take a note and act against it now?
Sectors which are doing better and doing rapidly better include things like the GST e-way bill movement. And this is an indicator which tells us how goods are moving across the country. So it's quite a meaningful indicator in terms of giving us a sense of how things are recovering. And the sense we're getting from the GST e-way bill data is very much corroborated by things like rail freight as well as by the port cargo traffic data. And of course, because of higher commodity prices, the value addition in terms of the value terms, non-oil exports growth is also very high. Similarly, petrol consumption, electricity generation, Coal India's output, all of these indicators are pointing to a much higher level of activity in April 2022 compared to April 2019. However, in that month, we still had some lag as far as auto output is concerned. And that's more because of the supply side issues and less, we believe, because of pure demand conditions. And also, the contact intensive sectors, particularly the airline passenger traffic, that still showed some amount of lag as compared to the pre-COVID level. But we've seen that the lag is compressing quite rapidly in the last couple of months. Lastly, one of the lagging indicators is diesel consumption. That's partly because of the hike in prices, but also because there's been a lot of divergence to the rail freight. So it's really reflecting the fact that demand has shifted on a certain set of routes and certain distances from the road sector to the rail sector.
Okay, Aditi, but how's the data trending for the month of May, especially in some, high frequency indicators like electricity consumption? Because our channel checks were suggesting that there is some tapering down as far as demand is concerned of electricity. What's your channel check suggesting?
Going into the month of May, the early indications are quite positive. We've got a good number of vehicle registrations for the early part of the month, and typically this is an indicator which peaks at the end of every month. So the early signs are quite encouraging. Also, electricity demand growth has surged in March, although that's partly because it's terribly hot in the north and central India. And petrol consumption on all counts, whether we look at a YOY, a month-on-month, or we look at comparison with pre-COVID, petrol consumption is really growing very rapidly and far outstripping what we're seeing on the diesel side. So again, a combination of what I talked about earlier, higher prices, is creating more sensitivity for diesel as well as the rail freight the meaningful changes that were made by the Indian Railways over the last couple of years that have really helped to divert a lot of freight to the rail sector from diesel demand.
What would be your view on WPI? When do you see it tapering, considering it's been in double digit for a while?
So this remains an area that we need to watch very closely. And although there has been some correction in commodity prices in the month of May, after the lockdowns in China and the slowdown in economic activity over there, it may not really be enough to meaningfully bring down the WPI inflation in the immediate term, at least until the geopolitical conflict continues in Russia and Ukraine. So going ahead, our view is after seeing the WPI inflation data that the probability of a back-to-back rate hike in the June policy review has only gone up. And we are penciling in a 40 basis points increase in the repo rate in the June 2022 policy and another 35 basis points in the August 2022 policy. After that, we expect there will be some pause to really look at the impact on growth. And our terminal rate expectation is 5.5%. We don't believe that in the current situation where the drivers of inflation are primarily supply side in nature and domestic demand is far from being exuberant. It's coming back, it's recovering, but it's really not exuberant. So in this kind of a situation, over tightening may only choke off the growth recovery instead of actually being able to clamp down on the sources of the actual inflationary pressures to start with. So our view is that a terminal rate of 5.5% may be appropriate. But of course, if the growth revival is going to be stronger than expected, then maybe a higher terminal rate could be warranted. But looking at the underlying strength of economic activity, we believe that 5.5% terminal rate is warranted as of now.
Right. What will be your view on rupee being at record low?
We believe that in the current situation, the overall pressures are more toward depreciation because of what we're seeing with dollar strength, with crude oil prices, and with the expected sharper tightening pace from the US Fed as compared to the MPC. In our view, the INR could depreciate to about 79 to the US dollar. But given the high forex reserves, the low likelihood of large FII debt outflows, given the fact that a lot of that is already behind us, and the narrowing inflation differentials with large global economies, we don't think that there is going to be too much more disorderly depreciation ahead. We think that given the size of the foreign exchange reserves, even though they have come down in the last few months, they're still quite substantial. And at a current account deficit expectation of 2.7% of GDP for FY23, we believe that the INR may not breach 79 in a hurry. And certainly, even if it does breach it, we expect it to pull back, from an overshooting sort of position fairly rapidly.
Okay, Aditi, thank you so much for joining in with that take and on the entire macroeconomic situation. We'll let you go on that note. But moving